Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and a rather sobering video update on this occasion. I have been mentioning how, basically we all thought it was safe to come out and play in equities again because the Federal Reserve finished raising interest rates. But two fresh, powerful forces are coming to bear on the US economy and economies elsewhere around the world. The first of those is that, yes, the Federal Reserve is on hold, but its tightening bias is a very real tightening bias threat, which could see the next move in the Fed funds rate being to the upside. In back of that, or what that has created, is this quickly elevated platform from which the private sector prices all of its lending rates. Those lending rates now in the private sector, which are, after all, what consumers and businesses experience, the Fed funds rate greatly determines where the banks are anchoring their rate levels, but it's actually the private institutions that determine what the American consumer and business is paying for borrowing money, for various purposes, of course. And I think I've mentioned before, US credit card delinquencies just hit an 11-year high. There are already very serious stresses for consumers out there. Now, that higher platform is at risk of moving even higher, but it's certainly not going to be going down. And so on top of that, and given there's even greater economic uncertainty now than there was a year ago, institutions are naturally pricing in larger margins for the associated risk they see in the property market in the US, in the manufacturing sector in the US, and for business generally in the United States. So that higher pricing, that process has yet to finish its run. So the Fed may have finished, even though there's a tightening bias. Let's say best case scenario, the Fed has finished, but the private sector is continuing to lift rates, and it's an appropriate response to the current economic matrix. So there's going to be further interest rate pressure. Interest rates have not finished going up in the United States. So that process is occurring in any case. And now on top of that, we have what I perceive to be another fresh wave of global inflation coming at us over the rest of this year. It's only in its infancy, it's only just beginning. It's not going to be the tsunami that I forecast last time and was accurate, a tsunami of inflation sweeping the world. So we got that right. And this time I'm not seeing a tsunami, but I'm seeing a significant wave, that's worth being well aware of. And it's coming from even interest rates themselves, the higher interest rates now causing businesses to price goods and services higher. So I always said that the Fed was overdoing it and it would actually add to inflation, and that they should have left it alone earlier. But I knew they would be hiking rates too far, and that's what they've done. And they could continue to do. So the inflation, though, is really coming again from energy and food. At this stage, mostly from energy, but we have seen some price movements across food markets that could suggest they are at least stable or moving higher. Energy prices are jumping higher. Natural gas prices in Europe jumped 30%, just jumped 30%. Now, it's from a very low base, but that's the point. It's a very low base of natural gas pricing at the moment compared to the crisis peak highs we saw. And that means there's plenty of room for even just a normal kind of market psychology price action rally here. But what's behind that, and remember, I think 18 months ago, I was warning people there's going to be a global nationalistic competition for energy reserves, well, that's happening. The United States has said they're going to rebuild their strategic oil reserves, but they haven't really done it yet. There's been a little bit of movement, but not a lot. So they still have a lot more to do. Europe's been very busy, of course, stockpiling as much as LNG, natural gas, as it can, and it is upwards of 80, moving towards 90% in terms of its reserve capacity. So that sounds good, but is that reserve capacity enough if the supply is interrupted? Now, the supply obviously is interrupted by both the conflict with Russia and the sanctions applied to Russia. But it's also now for Europe a problem that Asia has decided to build its energy reserves, including natural gas. And so natural gas prices around the world are headed higher. And this competition between Europe and Asia is likely to intensify. So I think natural gas prices just jumped 30%, but they could go another 100 to 300% higher. So there's a lot of risk to the upside for energy prices globally. We've seen oil rallying, as I forecast, quite significantly, steadily and substantially. That could still go to $95, maybe $94, $95, but maybe $110 at a stretch, but certainly into the 90s or high 90s, mid to high 90s is a very real possibility for the oil price. But what we need to be aware of is that the oil price already at this level is going to generate higher gasoline prices in the United States and around the world. And so the Fed is starting to perceive that inflation will come back. Everyone is expecting a little bit of a bump in inflation, but there's a background story here about natural gas, oil prices, potentially food prices that suggest that the rest of this year could see those markets continue to rally. And that is the fresh inflation wave that will absolutely stop any central bank from cutting rates. Maybe not in China, they have room to move, of course, but in the West, it will stop every central bank from cutting rates no matter what happens to their economies. And their economies are going to deteriorate further, but they won't be able to cut rates to rescue those economies because inflation will be on the move again, higher again. So they're not going to want to lose the battle against inflation, and they're just going to stick with rates where they are. So I do think the global US slowing that I see intensifying will keep the Fed from hiking rates, but they're going to maintain a strong tightening rhetoric bias, and it's not out of the question that we could see another Fed rate hike by the end of this year. So watch those underlying energy prices and food prices. They take a while to feed through into the CPI data, several months. And so that's why I'm suggesting to you that inflation could, particularly in the US, inflation could be on a move higher throughout the rest of this year. And the market has no pricing for that at the moment whatsoever. So just be careful on that front, that equity markets could be about to get squeezed by private sector interest rates continuing to move higher and energy prices continuing to move higher around the world, squeezing already fragile Western economies. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.